Hello there. Welcome back to Public Finance 86. In this video, we are still working on the question paper of November 2024. So we are going to look at question 3 of that question paper. So our question 3.1 reads a list for internal sources of revenue for capital projects and for local government. So you see that uh, the the internal sources that we have got tax funds, consumer tariffs, capital reserve funds, land trust fund. So these are the sources that we have. So moving on to the next question, it needs to discuss capital budgeting under the following headings. So basically, capital budgeting shows how organizations decide which projects to embark on and which assets to purchase. So basically, it is a process that a business is used to evaluate the potential profitability of new projects or investments. So this is the description of a capital budgeting that we have. So for the first part, 3.3.1, meaning of a capital budgeting. So we have that summarized in our other section, whereby we are saying capital budgeting is a process that organizations follow for evaluating and ranking. This is explanation that we have in terms of capital budgeting. So the second part needs us to explain on our capital budgeting tools. But the capital budgeting tools that we are supposed to mention, we have got a budget for each service, being the first one, and also we also are supposed to include for each capital project of a budget vote. So that becomes the second part. So we have that also, other section whereby we are saying our first point is a budget for each service, which is the total estimated capital expenditure for that year. This is the first part. Second part is for each capital project of a budget vote. The details of the cost of the project becomes the second part. So moving on to 3.3. You see that 3.3 explain the following terms. We have our tax deductions. So obviously, when we are having a deduction, which means there is a reduction that is going to be there, and obviously the deductions will be part of the expenses. So we have our tax deduction as an amount deducted from taxable income, usually based on expenses such as those incurred to produce additional income. So that is the description of tax deduction. So the question again requires us to explain what tax deduction. So we have a brief explanation that we have in terms of tax deduction, whereby it reads its tax generally applies to net income that the authorities allow aid expenses, traveling and entertainment expenses and pension fund contribution. So this is an explanation that we have on deduction. So moving on to the next question, it needs us to explain what but exemption, we are saying tax is not going to be applicable to those entities that are not making any profit. So that is to be exempted as is to be freed from a certain obligation. That is generally the meaning of exemption, to be freed from an obligation. So according to our explanation that we have there of exemption, it reads certain bodies such as non-profit making institutions are exempt from tax. This means they do not pay tax as long as they do not make any profit. So the exemption is coming from the being freed from the obligation of paying tax, because they are being exempted from tax. So basically, this is what we have for this part. Then move on to the next question, which now reads incentives. So we have incentives also, but incentives obviously they come as, for example, tax holidays, whereby the main objective will be to stimulate economic activity in the country, thereby also stimulating economic growth, whereby we are having more production of goods and services. So basically, now the explanation that we have again, according to another section, on intended to use a fiscal policy to stimulate the economy and the growth. It is possible that special exemptions are given to promote economic development. This might include exemptions to exporters and industries that take part in decentralization activities and trade. So you see that on incentives, there is an application of the fiscal policy, and we know that the fiscal policy uses taxation as one of the main instruments to control economic activity in the country. So basically, this is information that we have on 3.4.3. So moving on to the next part, which is now going to be the last part, which is 3.4, it reads discuss the indexing principle. So the indexing principle, you'll see that it includes the issue of compensation for a bracket creep. compensation for bracket creep. It also involves linking agreements to certain price indices, and also it is an attempt to lessen bracket creep. So basically, you see that the explanation is revolving around the bracket creep. So we have our explanation that we have there in terms of we have our explanation that we have there in terms of the indexing principle. So we are saying the first point is the Minister of Finance may decide to compensate for bracket creep. And then the second point, he or she might link rebates to certain price indices, such as the consumer price index. Then our next point is an attempt to lessen the effect of bracket creep. Then I give an example on the last point. For example, when you receive an increase in salary, which moves you to a higher tax bracket, hence in real terms, you pay more tax and could go home with less money than before the increase, which is the effect of the bracket creep. So basically, this is the explanation that we have, and this becomes the last part of our question 3. And thank you for listening. And hopefully the video was helpful. And please, let's not forget to subscribe and share to our channel. Let's share the link to our colleagues who are doing public finance at 6. Let's meet again in the next video.